As a business owner, have you ever paid for your company's expenses straight from your own pocket? And by doing so, you completely dismissed or disregarded the bank accounts for the company. If yes, do you think that is the right way to go about it? In fact, at the beginning, it could feel okay to just pay for the company's expenses directly from your own pocket. And you can argue that the company was struggling and you wanted to give it a boost. It is not a problem. It is okay. But from KRA's perspective, that could raise serious red flags, because KRA will wonder, where did the money that was used to pay for these expenses come from? And you could have had genuine reasons, that there are some people that you had offered services or sold goods to, but they delayed in making the payment. And your company needed to also pay its suppliers. And therefore, you decide to just help the company, and you directly paid for those expenses straight from your pocket. The problem is, KRA does not understand that story unless you keep proper records for your business. How you should go about it is in that extra money that you want to pump into your business. Let's say, for instance, it is 200,000. There are some expenses worth 200,000 that you need to pay, and your business does not have this money. Instead of paying this 200,000 directly from your personal savings, you should first deposit this money into the bank account for the company, so that there is an income that is seen coming through the bank statements. But to avoid KRA confusing this income as sales that were done by the business, you ensure that you record it either as a loan that the director is making to the company, or as an additional equity that the owner is adding to his business. The good thing with doing that, if you register it as a loan, KRA will have no problem with you when you finally decide to withdraw that 200,000 to repay yourself. If you don't do that, KRA will question you and will think that withdrawing that 200,000, you are trying to evade taxes. So it's good to record it as a loan. You can choose to record it as an additional equity that you are making to your business. By doing so, you will not be required to withdraw that amount of money, because it is equity that you have pumped to your business. But the good thing is that KRA will not suspect that the additional income that has come through your bank account is some sales that you did to your customers and that you need to pay taxes for. Or better still, if you used that money to pay directly to your creditors, KRA will not think that you have not declared some income, and that income that you have not declared is the one that was used to pay for your creditors or the expenses of the company. So next time, when you want to make a contribution to your company, just ensure that you don't pay that amount of money directly to the creditors of the company, or you don't pay for expenses directly from your own pocket. Ensure that you first deposit that money into the bank account, then from the bank account of the company, that's when you pay for the expenses of the company. When you do that, there's a clear audit trail, and anyone can see that this one was either a loan coming from the director, or it was an additional equity that the director wanted to make to his company in order to boost it. If you do that, you will ensure that you remain transparent and accountable. And accountability means sustainability of your business.